The Origins of Money and the Development of the Modern Financial System by L. Randall Wray. Money, the development of central banking, and the evolution to the modern financial system. Private alienable property, which creates existential uncertainty so long as historical time exists, as in the real world, and wage labor provide the conditions required for monetary production and generate the necessity to accumulate. Accumulation of reserves dominated in the money of account increases individual security and reduces reliance on lending from others. Each proprietor tries to set up his own reserves as a source of security, which will protect him in an unknowable future and from the need to ask credit of other, similarly isolated proprietors. End quote. Heinsohn and Steiger, 1989. These reserves consist of media of exchange and means of payment denominated in the unit of account. They may be private IOUs, commodity money, or government fiat money. The development of these representations of money will be discussed below. These security reserves provide a source for lending or temporarily disadvantaged individuals. These security reserves provide a source for lending to temporarily disadvantaged individuals. They are lent at a rate of interest determined by the risk of the lender incurs from parting with his margin of safety. The existence of interest also means that the borrower will have to produce in excess of subsistence in order to meet the interest costs and repay principal. Footnote 29. This guarantees that payment commitments grow over time at the loan rate of interest. See Wray, 1991, A, for a detailed discussion of the relation between accumulation and the rate of interest. Because banks are profit seekers, they will not make loans without requiring interest. This means that in the aggregate, outstanding loans will grow at a rate determined in part by the rate of interest. End footnote. This generates a logic of accumulation in any society in which most money is created as part of a contract that provides money now for more money later, and in which production always involves money now for more money later. If accumulation falters, these nominal contracts cannot be met. The logic of a monetary system, then, requires that the nominal money supply expand by at least the amount necessary to meet the expansion of incomes due to interest income growth. If it doesn't, a crisis develops. Monetary production cannot be constrained by a fixed money supply, nor by a commodity money whose quantity expands only upon new discoveries, for this could make it impossible to meet contractual commitments to pay interest. But since these commitments are in terms of the money of account, whose supply is determined primarily in the private contracts between debtors and creditors, money growth cannot be controlled except by interfering with private initiative in stipulating contracts. The quantity of wheat money of account can never be constrained by the quantity of wheat in existence. Rather, the quantity of wheat money created in contracts is constrained by the willingness of the lender to accept the promise of more money later in the form of interest. The same principles hold regardless of the money unit of account chosen, whether it is the dollar or the yen, and regardless of the medium of exchange used, banknotes, bank deposits, gold coins, or government money, which would be denominated in the money of account. As the money of account is nothing more than the terms in which promises to repay or to engage in exchange are denominated, anyone can create money, as long as one's liabilities are accepted by a counterparty who is a willing participant in a forward contract. Thus, by creating money, one may spend now, pay later. That is, one may receive something today merely on the promise to deliver money tomorrow. The money to be delivered tomorrow will take the form of a money-denominated means of payment. it can be obtained by exchange in the market. While the earliest monetary liabilities were merely two-party contracts, gradually privately created liabilities, denominated in the wheat of money of account, began to circulate and function as media of exchange and as a means of payment. In order to enhance the ability of privately created money-denominated liabilities to circulate, IOUs would be accepted by trustworthy individuals or institutions through an endorsement that guaranteed the IOU. Footnote 30. As discussed above, temples may have played this role initially. End footnote. A primary example of a privately created liability that circulated among third parties is the inland bill of exchange. Footnote 31. The first bills of exchange were probably foreign bills used to transfer purchasing power across time and place. Money as a unit of account was created whenever a bill was drawn. As soon as a bill was accepted by a bank or acceptance house, it became a gilt edge, or an acceptance, which could be used as a means of payment. Interestingly, goldsmiths were among the primary users of inland bills of exchange, first for their own account and later to transfer gold for their customers. It would be the bill that traveled, not the gold. Bills of exchange were the primary medium of exchange used throughout Europe to circulate goods until relatively recently. Kriegel, 1988. End footnote. A bill is created as part of a forward contract which is written in terms of the money of account. The bill may circulate, especially on endorsement, among third parties as a means of payment and as a medium of exchange, or it may be held as a store of wealth. The liability represented by the bill will be retired through the use of a means of payment, either another bill drawn on a third party, commodity money, or fiat money, at which point the money of account created as part of the bill of exchange forward contract is destroyed. Footnote 32. See Ray, 1990, Chapter 2, and Usher, 1953, for discussions of the history of the bill of exchange. End footnote. This brings us to the primary problem of a privately created money-denominated liability when it is used as a means of payment, medium of exchange, or store of wealth. Its issuer might default. To further increase the circulability of private IOUs, these would be made convertible under specific conditions into other media of exchange. Thus, the early private liabilities written in terms of the wheat unit of account would be made convertible into wheat. Later, these would be made convertible into the precious metal wheat-denominated stamped metal bars used by temples. Finally, after the development of stamped coins, private liabilities could be made convertible into currency. At all stages, however, private liabilities were also made convertible into other private liabilities, normally into those issued by relatively more credit-worthy individuals and institutions. A brief exploration of the history of commodity money is in order to demonstrate that it is not the natural form. Keynes shows that the early money of account in Babylonia was the mina, a unit of measurement consisting of 10,800 grains of wheat. Keynes, 1982. He notes, quote, "The unit of weight is given by counting grains of wheat." End quote. Keynes, 1982. As another example, the Roman pound was equal to 6,912 grains of wheat. Furthermore, quote, "All weight standards of the ancient and also of the medieval world have been based on either the wheat grain or the barley grain." Keynes, 1982. Of course, weight units pre-exist money. They were already in use to measure tribute paid to temples. Heinsohn and Steiger, 1983. These weight units were carried over into the monetary units in which credit money and later commodity money were denominated. It is significant that the standard coins of Greece and Babylonia, the stater and shekel, respectively, each had a weight equivalent to 180 barley grains, implying that the unit of account came before the coins. Heinsohn and Steiger, 1983. Cipolla also acknowledges that the notion of money underlying the names of monetary units and coins in the Middle Ages was, quote, the primitive notion of a standard of weight, end quote. Cipolla, 1956. But he goes on to argue that this is rather peculiar and, incorrectly in my view, attributes it to a movement away from a monetary economy and toward a barter economy in the Middle Ages. Actually, weight had always been the basis of monetary units. Thus, it is not a coincidence that the ghost money used throughout Europe after the 10th century was denominated in the pound. This was not due to the longing of medieval man, as Einaudi believed. Rather, the money of account was traditionally measured in weight units, a practice that can be traced to the early weight-barley units of ancient times. Indeed, the Babylonian mina, a money of account, averaged 504 grams, 10,800 wheat grains, which is very close to the modern pound. Heinsohn and Steiger, 1987. The Babylonian shekel, or the Milanese ducatoon, or the French écu coins, were all valued in terms of the money of account, which, in turn, was always a weight unit. Precious metals were not chosen to be used as coins because they are intrinsically worthy. Rather, they were chosen for technical reasons, and their worth was derived from the value of the social unit of account, wheat or barley. Credit money would also be denominated in the money of account, as long as the debtor did not default on his/her liability. The credit money could not be debased relative to the money of account. However, commodity money, gold, silver, or copper coins, could be debased relative to the money of account through clipping or reduction of fineness. This is because once it has been established, for example, during Charlemagne's reign, that 20 coined silver shillings of the maximum obtainable purity shall weigh 1 pound, any reduction of weight or purity will devalue the shilling, so that more are required to equal the pound unit of account. But this will not devalue the money of account, or the value of credit money denominated in the unit of account. It is significant that the value of minted coins was frequently determined not by nominal face value, but by weighing, to take account of clipping and loss of metal in coins due to normal wear caused by handling. Losses due to wear alone amounted to 1% per year. Monroe, 1979. Einaudi argued that the ghost money was never coined. In contrast, Cipolla argues that all the ghost monies were coined in the late Mediterranean world because he, like Einaudi, identifies real money with media of exchange, rather than with the unit of account. He assumes that ghost monies were created to simplify transactions in a variety of media of exchange, but is forced to conclude that by the 14th century, the ghosts were bringing confusion all around. Cipolla, 1956. Actually, things were not so confused as Cipolla believes. In Roman times, the gold solidus was minted at the rate of 72 coins per pound of gold. Thus, the coin unit was equal to 1/72 of a pound of gold, the money of account. This same unit was later adopted in medieval Italy as the florin, 72 of which equaled a pound of gold. However, in the 11th century, Charlemagne adopted a silver pound unit of account, such that a pound of silver was equal to 20 shillings, or 24 pennies. Only the pennies were coined, but accounts could also be kept in terms of shillings and pounds. Cipolla calls the pound and shilling the ghost monies of account. At the same time, the gold florin also circulated, and was equal to one of Charlemagne's silver imaginary pounds, or to 20 imaginary shillings. Eventually, however, a shilling coin was minted, leading Cipolla to argue that the ghost money was coined. Over time, the quantities of precious metals in the shilling and penny coins were reduced. Thus, by 1445, it took 768 penny coins to equal a real pound of silver, or a real florin coin. By the early 1700s, 266 real shilling coins were required to equal one real florin gold coin, which was never debased. However, according to Cipolla, in imaginary terms, a pound was still defined as 20 shillings, or as 240 pennies. Thus, even though the real florin coin was worth 768 pennies, Cipolla claims the ghost florin was now worth 384 pennies, so that one real florin was worth 2 ghost florins, leading to Cipolla's remark concerning confusion all around. There is a simple explanation for this. Charlemagne's pound was no longer the money of account. Charlemagne's attempt to shift to a silver pound unit of account would be successful only so long as the silver coins were not debased, in which case they would retain a stable exchange rate with the gold florin, which was explicitly based on gold. However, as the silver coins became debased, they lost value relative to the gold-denominated money of account, even where accounts were explicitly kept in terms of silver pounds, shillings, or pennies. Conversion to the gold money of account was necessary because the silver imaginary pound, based on 240 debased pennies, continuously fell in value. Cipolla argues that, quote, all the systems of account in existence in those days were actually based on and tied to a real coin, end quote. Cipolla, 1956. Clearly, this was not the case. These systems of account were based on a precious metal weight equivalent. This would be consistent with the units used for coinage only so long as the coins remained full-bodied precious metal coins. Thus, the recognition that the money of account, imaginary money, comes before any particular commodity money allows us to clear up the confusion in the accounts of Einaudi and Cipolla. Footnote 33. Frederick Lane provides a very similar example to that discussed by Cipolla. In Venice, between the 12th and 14th centuries, the governments experimented with a silver standard. The official unit of account was the silver libra, or lira, pound, composed of 240 denarii, pennies, which were coined. However, over time, the various coins became debased due to clipping, wear and tear, and intentional debasement by the government. That is, the silver content was reduced. This led to the development of at least 4 different silver monies of account. Each time a new silver unit of account was created, the government would try to obtain purchasing power by coining it, but because the government would then debase the coins, these would lose value such that more were required to equal the unit of account. Even when the government would pass laws which legally determined rates of exchange for the coins in terms of the various monies of account, these would not hold in practice. Indeed, by trying to set a value for a coin in excess of its silver content relative to a silver money of account, the public would merely abandon that money of account. The search for an invariable money led Venice to return to the gold money of account. Thus Venice, which began to mint the gold ducat in the 13th century, with the same gold content as the florin, returned to gold in the 14th. Quote, the lira de grossi, now firmly based on gold ducats, were the standard of value used in wholesale trade, banking, and foreign exchange, and in recording and paying the public debt and salaries of high officials. End quote. Lane, 1977. The experience of Venice, follows very closely with that of Charlemagne. Coining the money of account leads to problems, unless the coin is never debased. It also shows that contracts could be written in a variety of monies of account, and in a variety of coins. Lane discusses the problems that arose when contracts were written in terms of a unit of account or a coin that was falling in value. See the discussion below. End footnote. With the development of precious metal coins, we finally arrive at the goldsmith stage, at which orthodoxy theory begins, with a commodity money gold that is deposited with the goldsmith, who discovers the deposit expansion process. Footnote 34. Actually, goldsmiths got their start as safe depositories for gold plate rather than coin, and this was due to the perfidy of Charles I. That is, it certainly was not natural that people would leave their valuables with the goldsmiths. They did it only out of fear of the crown. Private correspondence from J.A. Kriegel. End footnote. Actually, the process worked in reverse. A commodity money could not have developed before the development of a money of account, which is necessarily the result of private debt contracts. The private liabilities created in these contracts have circulated before and concurrently with commodity money as media of exchange and means of payment. The commodity money is developed for technical reasons, but becomes the reserve money because private credit money is subject to default risk and exchange rate risk. That is, the holder of private credit money faces the risk that the value of this money will fall relative to the money of account. It is not that deposits of commodity money make loans and credit money. Rather, loans and credit money generate a desire to hold small reserves of commodity money in order to ensure convertibility. Gold and so on is not money, nor has it ever been money. Footnote 35. Significantly, unstamped or unminted metal does not perform the functions of money. Reserves of gold could not be money. The money of account must have existed before gold reserves, denominated in the unit of account, could be money reserves. End footnote. Money is the socially determined unit of account, but all privately issued money-denominated liabilities expose their holder to at least some risk, and to make this risk palatable, credit money is made convertible into other forms of money-denominated assets. The full-bodied commodity money is the risk-free representation of the social measure of value. As such, it is initially chosen as the ultimate backing for credit money. The quantity of commodity money available, as discussed above, never constrains the money of account supply. This means that wholesale conversion, liquidation, of private IOUs can never be accomplished in the aggregate. That is, a credit money economy based on commodity money reserve collapses if there are attempts at conversion. However, declining confidence can lead to a run on credit money, which cannot be met through liquidation. Instead, a trusted individual or institution would try to calm the fears of holders of credit money by certifying the financial soundness of the issuer. If confidence could not be restored, the issuer would default, and the credit money would lose its value. This could generate additional runs, could degenerate into a financial panic, and could lead to a debt deflation. As in the case of all other capitalist countries, England developed a pyramidal financial system. Footnote 36. See Foley, 1989, for a discussion of the financial system pyramid. End footnote. Each economic agent would issue liabilities made convertible into liabilities of an agent higher in the pyramid. Thus, a firm would make its liabilities convertible into country banknotes. Typically, the borrowing firm would enter into an agreement with an accepting bank, issuing a bill of exchange denominated in the bank's liabilities. The country banks, in turn, made their notes convertible into notes issued by London banks. Footnote 37. Often, notes could be redeemed only at the London bank. This may have reduced the incentive to do so, but to some extent, it was a convenient arrangement for many note holders as a large portion of transactions took place in London anyway. End footnote. These London banks would hold the reserves of country banks, which included stocks, bonds, and London banknotes and deposits. If a run began on a country bank, the London bank would lend its notes against the reserves of the country bank. However, this arrangement was not sufficient to stop periodic financial crises. The obvious problem with a private lender of last resort is that its ability to stop runs by issuing its liabilities is always constrained. First, it must worry about its net worth, and second, it must worry about a run on its own notes. Footnote 38. Thus, banks worry about the risk of not being able to validate their outstanding liabilities, therefore have a preference for liquid assets. No bank can be its own lender of last resort. This is why banks charge interest on loans to compensate for their illiquid positions in assets. End footnote. Historically, governments had been typically very constrained in their ability to borrow or to issue fiat money. Individuals and institutions were reluctant to accept government liabilities, partially due to frequent governmental defaults. Footnote 39. Of course, it was not healthy to be a creditor of a crown in financial difficulty, for the crown could always solve its debt problems through imprisonment or execution of creditors. End footnote. Governments also tried to issue fiat coins. These were coins whose embodied precious metal was less than the promised value in terms of the unit of account. In reality, such coins were nothing more than government debt. One would take gold to the government mint and receive the fiat coins that represented a promise by the government that these could be exchanged in the future for gold. In this case, the coin really was no different than the paper used to register forward contracts. The coins were merely the physical evidence of debt contracts. This is why they frequently had cows or other physical objects printed on them, long before the head of the king appeared on coins. However, those who received the coin always faced the risk that at some later date the king would declare a lower value, in terms of the unit of account, for the fiat coins. Indeed, experience proved that governments frequently try to obtain purchasing power through this method. Thus, government money normally would not circulate unless it took the form of commodity money, with its value determined by the amount of embodied precious metal. In this case, debasement through clippage or reduction of the amount of precious metal would merely lead to rising prices in terms of the government money, thus the government unable to issue fiat money. Footnote 40. See Wray 1990 for a discussion of unsuccessful attempts at debasement and for a discussion of the rise of the Bank of England as the central bank of England. End footnote. The early U.S. government was similarly constrained in its ability to issue coins by the quantity of precious metals. Footnote 41. Furthermore, coins were commonly shaved or clipped due to a shortage of small denomination coins. For example, the U.S. bit, whose value was originally equal to an eighth of a Spanish dollar, was created by literally cutting the dollar into pieces to provide small exchange. End footnote. When the U.S. Mint was first created to provide small coins, it found itself faced with a shortage of copper, the precious metal used for the cent. The modern reader would expect that the mint would have substituted a common, cheaper metal. However, at this time, this would merely have caused the value of the cent to fall below 1/100th of a dollar, the unit of account. Thus, a mint worker, Henry Voigt, quote, cleverly thought to substitute a small plug of silver in the center of a small copper cent. This allowed the mint to use much less copper while retaining a full cent's worth of metal. End quote. Stevenson, 1992. The inability to obtain purchasing power by creating fiat money was finally solved through the development of central banking. As no private bank wanted to run the risk of accepting government liabilities that might be devalued by fiat, they had to be offered incentives to do so. The Bank of England was first created to provide purchasing power to the government by purchasing government debt and issuing banknotes. In return, it was granted various monopoly rights and other advantages. Perhaps the most important advantage was the sole right to issue notes in London. In other countries, private banknotes were taxed out of existence, again giving de facto monopoly rights over note issue to central banks. As London was the financial center, and as country banks already pyramided liabilities on London, the Bank of England became the Reserve Bank. This essentially gave the government vast purchasing power, for the Bank of England could buy government debt, and its notes, denominated in the money of account, would function as fiat money that was always desired since it functioned as the reserve. Gradually, a mono-reserve system was developed, with Bank of England liabilities serving as the primary reserve and as the apex of the debt pyramid. Wray, 1990. This is the prototypical arrangement now found in all capitalist countries. In all private property economies, then, money is a unit of account, created by a promise to pay. A pyramid of these promises evolves, each backed by or made convertible into a promise higher in the pyramid. Generally, only the liabilities issued by those who are relatively high in the pyramid will circulate as means of payment and media of exchange. Over time, there has been a continual narrowing of the types of liabilities that will circulate to those in the highest reaches of the pyramid. Thus, the financial system has evolved from one in which a wide variety of types of liabilities circulated to one in which government liabilities and the liabilities of banks comprise the vast majority of the circulating supply of means of payment and media of exchange. Footnote 42. For example, Cameron, 1967, reports that bills of exchange accounted for nearly 70% of the circulating money supply in 1800, while banknotes, specie, and bank deposits together made up only 30%. By 1855, banknotes alone accounted for nearly 40% of the circulating money supply, nearly as large a percent as bills. See Wray, 1990, page 69. Recently, this trend has been reversed to some extent in the U.S., primarily due to the government's apparent willingness to guarantee a broad range of private liabilities. End footnote. Central bank fiat money is, like all privately created money, merely an IOU, a debt denominated in the money of account. That is, central bank money and private money have always been fiat money. Furthermore, central bank fiat money was not the first type of government fiat money. Historically, there were examples of government fiat money that circulated before the creation of central banks, although this was the exception rather than the rule. For example, some of the Italian city-states were able to issue government liabilities that circulated regionally at a nominal value stated in terms of the unit of account. One of the reasons for the success of the money-denominated liabilities issued by the city-states seems to be that all the citizens of the cities were held to be individually responsible with unlimited liability for city debts. In other cases, Governments usually could only issue liabilities backed by a specific revenue source. For example, it was common for a crown to borrow against future tax revenues, anticipation of taxes. Perhaps the most important development that gave governments the ability to issue fiat money was the creation of representative democracy, in which case government debt represents the debt of its citizenry, much as the debt of the city-states was a debt of its citizens. In conjunction with a gold standard, this would allow a government to issue fiat money, representing a promise to convert paper or coin to gold, that would circulate at a value stated in terms of the unit of account. While this development deserves more attention, it is beyond the scope of this article, except to notice that governments certainly did not begin by issuing fiat money. Indeed, the full-bodied commodity money is a special purpose money issued by governments that are not sufficiently creditworthy that their liabilities will be accepted. Governments were able to issue this commodity money because the money of account was a metal weight unit, and not because gold is naturally money. While the first central banks were created to provide government finance, they gradually discovered that their position at the apex gave them the ability to function as lenders of last resort. Footnote 43. See Begahot, 1927, for a discussion of the evolution of the Bank of England's perception of its role in the economy. See Tuke, 1959, for an early recognition that the Bank of England could function as a central bank. End footnote. As they could essentially provide reserves without limit, merely by discounting the assets of other banks, they could always stop a run. This greatly increases the stability of the capitalist system, for it solves the primary problem of a commodity reserve system. The supply of reserves becomes elastic. This does not mean, however, that the central bank controls the supply of privately issued money-denominated liabilities. The quantity of Federal Reserve liabilities does not limit the supply of dollar unit of account money any more than the supply of wheat limited the supply of wheat money of account. It merely means that an accommodative central bank can prevent debt deflations, while a commodity reserve system cannot, because the supply of commodity money cannot accommodate the need for reserves. It also helps to narrow the types of liabilities that will circulate. Those guaranteed by the central bank will displace others. However, this is true only to the extent that the central bank does not accommodate the need for reserves. A system that relies on accumulation functions more smoothly if debt deflations are avoided. The purpose of accumulation in a capitalist economy is not to accumulate widgets, nor is it even to accumulate widget-making machines. Accumulation has only one purpose, quote, to end up with more money than it started with, end quote, Keynes, 1997. The money to be accumulated is, of course, comprised of the assets denominated in the money of account. This is the social measure of wealth. A run to liquidity generates defaults and halts the accumulation process. It even leads to significant decumulation of wealth if it spreads. A system based on commodity money reserves will periodically experience debt deflations. In contrast, a central bank reserve system need not, thus supports accumulation. An accommodative supply of reserves is a fundamental advance over the commodity reserve system because it eliminates decumulation at the aggregate level. Again, an accommodative supply of reserves is essential. To the extent that the central bank tries to constrain the growth of reserves, it abandons its responsibility for sustaining accumulation. As mentioned above, when credit money is denominated in the money of account, its nominal value can fall only when it is devalued relative to the money of account. for example, due to the fear that its issuer will default. However, after the development of commodity money, some private liabilities were made convertible into coins, and some credit money was denominated in commodity money, say silver shilling coins, rather than in the money of account, say gold imaginary pounds. Footnote 44. As mentioned above in Note 33, Lane, 1977, discusses the common practice of writing contracts in terms of a variety of coins and monies of account in Venice in the 13th and 14th centuries. End footnote. In the absence of debasement, it would not really matter whether credit money were denominated in commodity money or in the unit of account. However, as discussed, debasement of coins became common in medieval Europe. This added a further avenue through which credit money could lose value, as any credit money denominated in the debased coin would lose value relative to a money of account. On the other hand, the debtor whose liabilities were denominated in the gold pound, money of account, would find that repayment in terms of a debased silver shilling coin became more difficult, increasing the likelihood of default. In medieval Europe, both types of private credit money existed. Some was denominated in the unit of account, while other credit money was denominated in terms of coins. The dual system, consisting of an invariable unit of account with commodity money, whose value relative to the money of account was determined by the quantity of embodied precious metal, was not conducive to an economic system based on credit relations. As Cipolla, 1956, argued, a system based on a stable coin would favor creditors and rentiers, while a system based on a deteriorating coin favored debtors and entrepreneurs. In fact, these divergent outcomes arise because the system is based on a money of account, but debts could be written in terms of a coin, which might be debased in terms of the money of account. Polanyi, 1968, writes an attempt to commodify money, another of its fictitious commodities, as countries throughout Europe established a gold standard. Actually, in one sense, the gold standard was nothing new. Since Roman times, Europe had used the pound as the unit of account. The establishment of the international gold standard actually represented an attempt to prevent debasement of commodity monies within countries and debasement of national currencies among countries. Credit money could then be denominated in the commodity money and made convertible into commodity money. The commodity money would be made convertible into gold at a fixed rate of exchange as established by the money of account. A pound banknote can be converted into so many shillings. So many shillings equal a pound sterling. So many pounds sterling equal an ounce of gold. While the gold standard, there is no longer a distinction between credit money denominated in the money of account versus credit money denominated in terms of commodity money. When devaluation occurs, it means that the unit of account, credit money, and commodity money all fall in value relative to gold, but not relative to one another. This brings us back to Einodi's ghost money. One of the functions of a commodity money is to provide a common currency, denominated in the ghost money of account, into which all other monies are convertible. This is necessary so accounts may eventually be cleared. The commodity money could be used to settle net debts. With the development of fiat currency, denominated in the unit of account, and the value of which, in turn, was fixed relative to gold, we have a domicile currency used to clear accounts. The earliest example was the Bank of Amsterdam, which guaranteed a uniform gold unit of account used as the common denominator for various media of exchange, all of which represented debts. The uniform unit of account, both domestically and internationally, was necessitated by the dominant use of bills of exchange. If the various bills were made convertible only into private domestic liabilities, their values would be exceedingly uncertain. Thus, the gold standard did not arise naturally as money was invented, but was created because most money took the physical form of privately issued bills of exchange and other private liabilities. Of course, in the U.S., we had treasury notes, denominated in the dollar unit of account, and at one time also made convertible into precious metal at a fixed exchange rate. These fiat notes served as a reserve for private liabilities, and they were used to clear accounts. It is interesting to note that the U.S. ghost money is coined very early in the history of the country, while the European ghost money remained uncoined for centuries. This ability of the government to issue by fiat the unit of account money represents a major advance. But it also conflicts with the gold standard itself, because a run on a convertible currency results in loss of the gold reserve. Creation of the gold standard eliminates the dual system mentioned above, in which debts could be written in terms of either an invariable unit of account or a commodity money that could be debased. With a gold standard, credit money that is made convertible into gold can fall in value relative to the unit of account only in the case of bankruptcy of the debtor. Still, however, such bankruptcies can spread whenever there is a run on credit money due to the pyramidal structure of debts and due to the limited quantity of gold reserves. Thus, lender of last resort intervention is required to prevent debasement of credit money relative to the money of account. This is possible only if an elastic supply of fiat money is available. But this is not consistent with a gold standard. This is why the central banking function conflicts with a gold standard, and is one of the reasons the gold standard is commonly abandoned during crisis. The gold standard permits devaluation of a nation's unit of account due to a run out of the currency or to deliberate government policy relative to the units of account of other countries. As the pound sterling falls relative to gold, it also falls relative to the German mark. Thus, while the gold standard resolves the problem concerning the dual system within a country, it does not provide an invariable international unit of account. Footnote 45. However, to some extent, this problem was mitigated when the pound sterling was used throughout Europe as the international unit of account, in which most foreign bills of exchange were written, even for trade between two countries that did not involve the UK. End footnote. A debt denominated in the dollar unit of account will fall relative to the value of the pound sterling unit of account whenever the dollar falls relative to gold. Furthermore, the gold standard is as unworkable when there is a run out of a particular country's debts, and currency as the commodity money reserve is when there is a run out of a particular bank. Just as the national system requires an elastic fiat money reserve system to stop national runs, the international system requires an elastic fiat money reserve denominated in a universal unit of account to stop international runs. Again, the international gold standard has been repeatedly abandoned during crises. The world essentially adopted a dollar unit of account after World War II, but the international monetary system broke down again in the early 1970s when the U.S. abandoned gold. Even though the dollar has remained as the primary international unit of account, and even though the international supply of dollar reserves has been somewhat elastic due to actions of the Bank for International Settlements, the World Bank, the IMF, and national central banks, crisis of the international financial system remains one of the most important problems facing the world today, a topic beyond the scope of this paper.